Thank you and good afternoon, my friend. I'm from the US and I can speak a little bit of Spanish.
Will be more informative for you if I speak in English. So I'm going to go that way. And boy, what a conference this is. Thank you, FIAP. Thank you, Enverico, for the opportunity to be here. What a wonderful conference this is. I've been cooped up in Seattle, Washington for almost 2 years. So I am quite excited to be out meeting people, understanding what's happening with pension reform all over the globe. And by the way, one of the themes for this meeting has to be the amount of reform. My goodness, has anyone said, well, no, we like our system exactly the way it is, we want no change? I've heard none of this. All I have heard is evolution, change, evolvement, searching for better systems, which is what I'm here to talk about today. Pension multifunds, some people call them target risk, some people call them balanced funds, and I want to compare the efficacy as an investment of those balanced funds against target date. Target date has been gobbling up assets in the United States at a very aggressive pace. So let's talk about the benefits of target date. What does it bring? Why is it so popular? Let's actually also look at some considerations and limitations in the use of target date and the ability to shift to target date. Now, luckily for us, we have an example of a country that has shifted from target risk to target date. It's Mexico. And it happened very, very recently. So we have a lot of data, both in a practical sense, and a lot of information we can point to about that experience. We'll go through that case of Mexico. We'll have some concluding thoughts. And you know what? One thing I decided to do was come out with a clear view on this question. And it is our view at Principal that target date funds offer distinct competitive advantages over target risk multi-funds. And I can give you 5 very good reasons why that's true. First, obviously, from a public policy perspective, the easiest way to hand out advice is just to know how old everyone is. No matter who you are, no matter where you are in the world, you know how old you are, and you know when you want to retire. That's easy. What's hard is knowing your risk appetite. Am I conservative? Am I moderate? Am I aggressive? Now, I've been managing balanced funds for 20 years, and while it hurts my feelings, people like target date. They like target date because they like the simplicity of it. And in many ways, I think that's the key feature. The simpler, the better, and advice is easier. Now, number 2, you no longer have to rotate on an age-based system. From fund to fund to fund, every transition point, there are transaction costs and there are frictional expenses. If you have a J-curve from alternatives, if you have a deep value investment, your investors can lose that return as they migrate to the next portfolio. In target date, it is only one portfolio. And that one portfolio de-risks automatically over time, reducing transaction costs and giving investors a clear picture on what to expect. Thirdly, let's talk about what Lifecycle really does. It moves investors, and I'm a portfolio manager, away from thinking about total return, and perhaps even away from risk-adjusted return. And it instead moves them towards maximizing income replacement. That is the goal of target date. Maximizing income replacement, which has a very different investment outcome than target risk. Mostly because the horizon's different. If we went around the world and we pulled every portfolio manager in Chile, Mexico, Spain, it's everywhere, and we said, what is your horizon in target risk? I think they would say about 10 years. That's my guess. Maybe 15. Target risk, that can quadruple, triple, 30-year horizon, 40-year horizon. That opens up new opportunity sets, that allows you to give up liquidity, that allows you to find new investments that do a lot, I think, to enhance the overall efficacy of the investment and the returns available ultimately in retirement for individual savers. We talked about length. Let's also talk about benchmark. In Chile, there are 7 AFPs that are very competitive. And what you start to see is actually a lot of decision-making and gamesmanship around who's making what decision first. There is herd risk in this, and it's because they're evaluated relative to peers. and this is true in other areas as well. By choosing a target date strategy, you have the option to choose a neutral index reference portfolio that in many ways minimizes the risk of peer relative compensation and gives investors a pure independent view of markets. Now, every country I've seen has a home bias. We can correct for that with benchmarks, but there is a benefit to having a common unified benchmark across managers to compare results. So those are my 5 key ideas. 5 key ideas around why target date delivers a superior outcome in a defined contribution mandatory pension scheme. But why are we even talking about target date? Why does it matter? I think it's my home country that had a lot to do with this. We are now actually, if you go to recent data, up to about 1.2, 1.3 trillion in target date assets total. And what really changed this, and now the US system is different than many of the others, was that in the voluntary savings business in 2006, the US Congress gave companies legal protection to automatically default enrollees into target date. That protection, that safe harbor from lawsuits, is what really allowed for the rapid growth of target date. And once it took off, it has now become dominant. 93% of plans have a target date in them in the United States. And in fact, that number, 57% of total plan participants at the bottom, that's higher now. Actually, new contributions are actually exceeding 60% into target date. So it is the clear winner. It is the runaway champion in the voluntary market in the US. But what can we learn about other mandatory systems outside the US? Well, what is a target date really fund designed to do? From an investment standpoint, it should do 2 things. It should deliver performance to grow assets, deliver returns. But on the other hand, it needs to give liability funding, essentially to shield the saver from the risk of the change in the liability. Now, there's going to be, in fact, some limitations to what we can do with target date. The first will be familiar with many of you, regulatory constraints. How much capital is allowed outside of the country? In what currency? How is that going to be distributed? That's a constraint. Where are your equities? Are they in the home country? Are they international? That's a constraint towards return. But there are also very, I think, important limitations around the liability funding. What is the access to real rates? Do we have access to the right instruments for duration matching? These are not always true in all cases. I'd also like to talk about misaligned incentives, because what you see here is, in fact, even though we've shifted to maximizing replacement income, investors still just see returns. And they're not evaluating our success necessarily on their funded status. So we have this dissociation of ideas between what success looks like that does affect how target date funds can work. You also have to worry a great deal about flow management, as it's very, very critical in the early years, the long-dated vintages, to manage the rebalancings very effectively. Now let's go over to Mexico, because I do think that Mexico can be an extremely informative example to all of us around how this can work and what we can learn about a system transitioning from multi-funds to target risk. So what were we trying to do here? Fundamentally, we were trying to lift the savings replacement rate from 29% to 43% only by changing the asset class mix, by pursuing more risky investments. That curve that you see of replacement rates on the right-hand side of that chart, that gets you to the average for the system of 43, right? And you have to think about that replacement rate, but that does not yet even include the enormous change in contributions from 6.5% to 15%, which will further move up the Mexican market towards a really, I think, attractive funding rate, significantly higher than what it has been historically. That said, target date fund implementation allows for the expression of views and the efficacious investment management to allow for a strategy that maximizes, again, definitions of success. Okay. Now, the chart that you see on the right, that is a histogram that shows you how we can take the 5 industry-wide across all of Mexico, the 5 balanced options, conservative, moderate, aggressive, and look at how they get mapped into vintages of target date. It's very interesting to see how the belly of the curve, the gray bars, the orange bars, really take up the most significant portions of this, while SB4 and SB1, SB0, quite small. So a lot of this depends on how you actually map every single participant onto a particular spot on a glide path, every person in Mexico. Right? Think about this. Let's talk about the challenges to that. Theoretically, and a target date fund, it assumes that you start with 0. And on a theoretical level, when you're starting with 0, it changes your risk appetite. And an immediate hard switch, I think, to a target date strategy has the net effect of massively increasing risk appetite all at once. And that can be a shock to the system on a theoretical level and on a practical level. Because that sudden change in the portfolio might change asset prices. It might change it very, very quickly in the liquid markets, particularly on the debt side where that happens. And I think that's a very practical challenge that we should be considering. Also, too, knowing where each investor should be on the glide path requires a good deal of data about each individual, and it requires systems checking, thorough operations to ensure no one is lost in the migration from target risk into target date. And that does not even get into how fees are collected. Some of them are collected on AUM in some places. Other times they're collected over salary. When you make these shifts from one system to the other, how you pay for this makes a great deal of difference in the ultimate outcome. So what's the solution? Actually, Paul, you talked about this. It's a slow transition. How quickly do you want to move? In fact, in Mexico, what we have agreed is that you are going to see a 2-year gradual movement towards the new benchmark, towards the new glide path, and towards the new elements of the investment strategy to limit speed and the damage with which speed can have effects on the marketplace. 2 years to get each participant to where they are on the glide path, and 2 years to avoid things like, I don't know, one of the most spectacular market collapses that we've had in the last several years from COVID. That happened right during this episode. And if you had, for example, think about that COVID drawdown that we saw in March. If you had a mandatory rebalancing system in that time, you would be forced to take tremendous losses in the conversion. So having flexibility, having a long time horizon to achieve the transition really results in a smoother effect for plan participants and gives investment managers the opportunity to time the market, to know when liquidity is good, to know when earnings are coming, and to essentially move there gradually. Because I want to talk again about 3 learnings that I think really make sense from the experience that we had in Mexico. 1, use of leverage. The use of leverage in the conversion allows us to navigate the constraints either on the equity or on the currency side to essentially shift the portfolios without violating constraints and keeping the investor at the right level of risk. That gradual, again, convergence is key. Well, it's a busy chart on the right, but the orange dots are where we were. The blue dots are the efficient frontier. So you don't have to be a finance expert to realize that the orange dots were mostly suboptimal. They were mostly suboptimal relative to the investment opportunity set that was available in target date. And by lengthening the investment horizon, improving essentially our ability to give up liquidity to chase returns, and while also essentially maximizing the outcome of replacement income, you can find out it's a significant improvement in the overall efficacy to move towards target date. Finally, you have to design this target date to deal with liquidity squeezes. They will happen. Investors move from fund to fund. In Chile, Felices y Forrados used to move funds left and right all the time. That has finally slowed down. But as you see those events, you need to handle the liquidity. You need to be able to build them and occasionally use treasuries, essentially to funded equities ratio, to essentially have that liquidity available at all times. But it is certainly achievable within the construct of the target date to manage the liquidity and to focus on that investment income. Okay. The proof, as we say, is in the pudding. So this is a comparison, as good a comparison as I could give you about the case of Mexico. On the blue line at the top, you see the return that we've had over the last 12 months, ended in August of this year, in target date funds on average. The brown line below it has many assumptions in it. I will be very clear, there's a lot of assumptions in that brown line. First, it assumes that we take a picture of the target risk funds when they stopped. And that picture, I'm going to hold constant throughout time. I'm going to hold how they were invested at their last moment throughout time and calculate their performance. And the accumulated alpha in the bottom bright blue is the difference. Now, this is a very, very brief study. This is only 1 year. And there's also a lot of assumptions in exactly what would have happened in an alternative universe. But to date, it looks like you're getting about 250 basis points per annum of excess return going into the net Mexican saver economy. And I think that is the kind of investment performance that delivers real retirements, real incomes for our savers. Okay, let's close it out with some summary comments. From an advice perspective, it's all about knowing how old you are and when you want to retire. And I think that that's something anyone can handle anywhere in the world. Knowing your risk appetite is far more difficult. I've seen investors get extremely confused on this. And mental accounting, by the way, is a terrible enemy of savers. They want to have this risk appetite for these assets. They want a different appetite for these assets. But that's not how it works in asset allocation. Going to target date lengthens the horizon. By going from a 10-year to an average of 30-year, we can essentially decrease our liquidity, get new opportunity sets, and improve the risk budgeting. Again, I'd also comment that the specific goal of target date is income replacement maximization. It's not necessarily to achieve benchmark outperformance. And that alone is going to have a more robust and more objective portfolio construction process. We talked about the glide path, and this last one that I really like, that when you think about the role of pension funds, and you think about the role of alternatives, illiquids, a lot of what target date funds can do is to drive local private investment in each market. And that leads to a more efficient deployment of economic capital, and it has a circular benefit, a circuitous benefit of local pension investment in privates that, again, develop the economy, help achieve the most efficient allocation of capital, and at the same time give your own retirees, again, that more comfortable income. Okay, I think I finished 3 minutes early, and you know what, that's good to keep us on schedule. So thank you very, very much for the time today, and I hope to be back at the next FIAP conference. Thank you.